Hello everyone, today I'm going to talk about an interesting but less well-known asset class called hedge funds. Now hedge funds don't openly market themselves and they tend to be rather secretive. So many people actually do not know what they are or what they do. Personally, I was actually involved with conducting due diligence on hedge funds as well as being a portfolio manager in one of them in my past career. So allow me to shed some light on this mysterious class in this video here. And again, like the previous videos, I will touch on a few simple questions. What are hedge funds? What are the different types of hedge funds out there? Why invest in hedge funds? What are the risks involved when you're invested with a hedge fund? And how do you invest in hedge funds? Okay, so without further ado, let's start. First question, what are hedge funds? Now, hedge fund is basically a legal vehicle that is incorporated to pool and hold money coming in from different investors itself. And this pool of money is then managed by a hedge fund manager. Okay, and when I say hedge fund manager, I'm not referring to the individual portfolio manager here, but rather I'm talking about investment management company that is authorized, right, to invest the money in a hedge fund on behalf of the investors. All right, so legally, right, this hedge fund and investment management companies are two separate entities, and for good reasons. Okay, because then this clearly segregates the investors' money from the investment management companies. All right, and an investment management company can actually manage multiple hedge funds. That is very common for very large asset management houses or very large hedge funds. So if you look at it, the structure is not that different or not that much different from that of a mutual fund. So what really sets the hedge funds apart from mutual funds? Right, the first big difference is hedge funds, or at least most of them, they are restricted by regulations and can only be offered to accredited investors. And who are these accredited investors? They're basically your high net worth individuals and institutions. So in short, they are those with lots of money, all right, and who are able to take on higher risks and are also deemed, right, to have the means to access the needed expertise required to understand the risks involved with hedge funds. Right, and of course, being limited to such a small pool of clientele, the hedge funds usually require a much higher initial investment. Okay, so this initial investment can range from a couple of $100,000 for smaller hedge funds all the way to millions, right, for large established funds. The hedge fund industry is also the one that popularized the famous 220 fee structure. Now, the 2 in the 220 represents a 2% management fee, which is already higher than what most mutual fund charges. Then there is the 20, which is what we call the performance or incentive fee. So this is like a profit sharing component, meaning the hedge fund will take away 20% of the profits and make for you. So if you make $1 for the client, it is going to take 20 cents away as its performance fee. Okay, so this is like the standard charge in the past, but things have evolved over time, and today fees among new funds are trending lower, and many have also come up with new fee structures in order to attract clients. For only being allowed to service accredited investors, hedge funds are a lot less regulated, right, by the authorities itself, unlike mutual funds. So in return, right, they can actually pursue any type of investment strategies that they want. They can go long, they can go short, they can take on leverage, they can use derivatives, they can make concentrated bets, they can decide to do trend following, they can also bet on mean reversions, they can trade spreads, and they can also invest into illiquid securities. So basically, it is like a no-holds barred, right? The sky is the limit. And this is also the most distinctive feature, right, that sets hedge funds apart from the rest of the asset classes. Now, we all used what we call market benchmarks when we compare the performance of a mutual fund. For example, we will compare a US large cap fund against the S&P 500. And that is fairly sensible, right? But within the hedge fund industry, it is actually very difficult to find a suitable benchmark since they are hardly bounded by any rules or constraints when it comes to running the strategies. So that means that everyone can be doing things very differently. So even between hedge funds running the same type of strategy, the difference can be fairly material as well. As a result of that, many hedge funds adopt what we call an absolute return benchmark. So that simply means that they set an average return target to hit. Like for example, it could be 8 to 10% a year, 10 to 12% a year, 15 to 20% a year, and so on and so forth. All right. So this also gels with their reputation of being able to deliver returns according to skills and being independent of the market. All these features I just mentioned is what sets hedge funds markedly apart from the other asset classes. And that is also why hedge funds are considered an alternative asset class alongside with private equity and real estate. Next question. What are the different types of hedge fund strategies? Now we can slice and dice a hedge funds in many different ways. And the first is by asset class. So hedge funds can specialize in one or more asset class. For example, they can be invested into stocks, fixed income, commodities, forex, volatility, cryptos, or even be multi-asset. Well, they can also be segregated based on the parts of the world they're focused in, based on geographies, right? So some may invest only in US, some may be only interested in Asia, some are focused on Europe, or some in Latin America. And some may be global, right? Meaning they invest all over the world. Okay, but most of the time within the industry, we segregate hedge funds according to strategies, all right? For example, are they equity long short funds? Are they specialized in event-driven strategies, or are they running volatility trading, or multiple different strategies? Okay, and actually within each strategy, we can even break it down further into finer details. Okay, but I won't be delving into that here. Next question, why invest into hedge funds? Now, first, hedge funds provide an alternative way to diversify your portfolio, right? Because your return stream is very lowly correlated to those of your traditional markets, while like stocks, for example. And they have historically also provided very good downside protection. So if you look at the data provided down here during each of these major crises, starting from the Kuwait invasion in the 1990, to the dot-com bubble in 2000, then to the great financial crisis in 2008, all the way up to the current great inflation period starting this year in 2022. Hedge funds actually consistently outperform the global stock market, and by a good margin as well. Hedge funds also allow you to access a wide range of different strategies and opportunities that you won't be able to get outside of traditional instruments like mutual funds. And if you have the right expertise to understand their strategies and to conduct a proper due diligence, hedge funds can actually be very valuable, right, in terms of complementing your existing portfolio. That is why large institutions like sovereign wealth funds and endowment funds, they always allocate a portion of the money to invest into hedge funds. Hedge funds also deliver more bang for the buck over the long term. And what do I mean by that? It means that they're better at squeezing out returns for every unit of risk that they take. Now, risk can be quantified in many ways, and in case you're interested to know, what I'm using here is a very common risk measure called volatility, right? But I won't be going into the math or the mechanics here. I might do a separate video on this next time, all right? Now, if you look into the figures, right, which is computed over the time from January 1990 to September 2022. So this is a 32-year period that covers multiple different market cycles. And if you look at it, hedge funds outperform the global stock markets. While it not only delivers a higher annual return, it does so using a lower level of risk. So in terms of return per unit risk, hedge funds actually deliver or produces, right, 1.3% return for each 1% risk it took. In the meantime, right, global stock only produces about 0.4% return for every 1% risk that it takes. What are the risks in hedge funds? Now, of course, everything has risks, right, including hedge funds. There is no free lunch. And the first risk is specific to the strategies that a hedge fund runs. And depending on what the fund runs and how it runs it, the risk can be concentrated in different areas for each fund. So a long equity fund, right, is going to have equity risk. So a fixed income fund will have the bulk of its risk within interest rate and credit risk. And those who are doing spread trading will have spread divergence risk. And funds will rely solely, right, on asset allocation phases, correlation risk. And those who are short, right, or those who took up short positions are susceptible to risk coming from short squeezes. Right, so these are some of the strategy-specific risks. Another risk is liquidity risk. And what is liquidity? So liquidity is the ability to move in and out of an investment quickly. So exchange traded products such as stocks and ETFs, they have very high liquidity because you can basically buy and sell them on exchange every day. Mutual funds are also very liquid because you can subscribe and redeem their shares on a daily basis. But hedge funds, on the other hand, are much less liquid. It is in fact not uncommon for them to have what we call lockup periods of a year or more. So that means that during this 1 year or more, you cannot take out your money. Or even if they do allow it, it might come with some heavy penalties. Okay? And unlike mutual funds, most hedge funds don't allow you to subscribe and redeem on a daily basis. So their frequencies are usually in the range of more like monthly to quarterly and maybe even longer. All right. Then some may also impose a gate term. So this means that a hedge fund can actually stop redemptions if it exceeds a certain percentage threshold. Okay, but this particular term here is actually meant to protect the situation of excessive redemptions, which can actually force the hedge fund to liquidate its positions aggressively. And in doing so, it may make the positions moved adversely even more against existing investors. All right. Well, another risk is style drift. So style drift means hedge fund managers started to deviate from what it is supposed to do for its strategy. It can happen, and very often it is because of changes within the market environment that makes it tough for the hedge fund manager to make money. Okay, then they'll start to do things that can be different from what they intended to do originally. So for example, before 2021, trend followers were actually suffering from a very long bout of underperformance, and some started allocating less and less to trend following and then more and more to other types of strategies. Then there were also short bias funds, which were at times forced to become long buyers, right, in order to stay afloat after the great financial crisis itself. Okay, so actually this is all right as long as what the hedge funds do is still within the policy mandate, right? It is like an evolution process, but it can be a problem if the hedge fund deviates too much, because then that invalidates why you invested in those hedge funds in the first place. All right, and style drift, unless the manager tells you up front, it can be very hard to spot. Well, the last risk I want to mention here is called the key man risk. Now, most hedge funds are very small setups with less than 50 people. Some had only like 10 to 20. And the key personnel are usually just one or two individuals, but in particular the founder, right? And these people are the ones that hold access to the investment strategies. Now, if these few key people leave the firm for whatever reasons, whether it is due to health, whether it is due to business or other priorities, then the fund may cease to operate. Or even if they operate, they may fail to deliver on their objectives, right? So this is what we call the key man risk. Last question, how to invest in hedge funds. Now, hedge funds are much less accessible than stocks or mutual funds, though they're more like private vehicles. For institutions, they can access it through their prime brokers, and for high net worth individuals, well, they can do it through their private banks, right? Or alternatively, you can also approach the hedge fund directly. Just simply look up their website and then look for the investor relations portion, then contact someone from there, and they will get back to you. And these days, there are also exchange traded funds that tries to replicate what hedge funds do, right? But not all strategies can be effectively replicated. So most of these strategies right now are constrained to asset allocation type of strategies like risk parity. So the choices are limited, but nevertheless, it is still one way to access hedge fund strategies. Well, the last approach is to DIY yourself. Now, not all hedge fund strategies are complex, and not all need a large size to run. For example, you can implement simple long-short, trend following, asset allocation, or even volatility trading on your own portfolio if you know how to do it. So if you do have the time and interest, this is an approach that you can explore. Alright, I've come to the end of this video. Thank you for watching, and I hope you took away some new knowledge about hedge funds today. Now, if you like this video, do us a favor and let us know by clicking on the like button below, and subscribe to our channel for more updates in the future, because we'll be releasing more videos in the time ahead. And do feel free to share our videos with your friends or anyone who you think might benefit from it. And for your info, at AllQuant, we also conduct online courses on investing. If you are interested, you can drop by our website for more details. So the links to our website is in the YouTube description below, right? Okay, so all the best to you, happy trading, and I will see you in the next video.